Well, hello and welcome everybody to our Maverick Psych Corner. Pretty excited to get through some of these videos. We do a lot of coaching here. This is Joe with you, by the way. And a lot of the times that I do coaching, it's psychology. It's pretty much, hey, we know how to do the ins and outs, but what are some loopholes or what are some things to look at? Why do I feel this way? Why am I doing this? Well, this is going to be a fun little video here. I'm going to spend the next 10-15 minutes talking about during a trade. I'm going to break this into a few things. This is going to be specifically the emotional mistakes and misuse of stops. I actually liked writing that. That was actually, I think, the longest title I've ever written here with Maverick doing these videos. But I talk a lot about the stops and why people put them on and stuff. But more importantly, the emotional mistakes. I wanted to make sure that I get that out as well. So let's jump right into it and talk about some of the things that cause us to do some silly things when we're in trades. This is my 2 cents. This is my opinion. A lot of it is. A lot of it is, my experience working with traders. So take it for what you will. Take responsibility for the outcome. This one's going to be a good one because it's going to be very specific to how you feel during a trade. So the first thing I want to do is get into a key concept. Stops are great. Okay? They're a great way to limit loss or risk in a position with very little management. However, you got to know if you're doing what you're supposed to be doing or if you are just reacting to what's going on in front of you. A very difficult thing to differentiate between the two, especially when you first start. So we need to understand what the true impact they have on our trade, along with misusing them, okay, when we implement that. Now, back in the day, folks, I started as a day trader, and I remember there was a market order and a limit order. And this was, yes, I'm dating myself, to what, 1999? Then they came up with a stop order, and I'm like, what's a stop? What is a stop order? And it's like, well, it's a market order that you could put out there, and once it hits, it triggers. You could buy, you could sell, you could cover. And I was blown away. I was blown away. Blown away to such a point that I had such ability to place an order anytime or anywhere I wanted to. And it became this. I did not have the, well, first of all, the emotional control for it, or I just wasn't responsible with it. And it's really interesting because it's like just because you have this really cool, powerful tool doesn't mean you use it correctly. And so I ran into this, and it was really fun to build this class because here you go. These are some common emotional mistakes, and I cut this down. This was probably a list of 20 things, but I just did some of the bigger ones. And these are my mistakes, and what was really fun about it is mistakes that I've seen other traders make, along with just myself. So implementing a stop immediately. Now I started with this one because it's one that people don't really think about. What they'll do is they'll come out and say, okay, well, I'm going to get in at $50. I'm going to put my stop at 1 ATR below that, and then we have our set stop, entry, and target, and you hit it all at once. Now, at the beginning, that's great, but what's interesting is too often we get that too tight and we put it on something a little too volatile. Now I'm gonna put in some options. I'm gonna talk specifically when it comes to statistics with stock, but options as well. Options actually have a built-in risk parameter based on the cost of the contract. Now with a stock, the closest that stop will be in a stock that works with you will be at inception, meaning when you buy it and you automatically trigger a stop order, it hits it the same. That should be, hopefully, the closest that ever gets. Because in a perfect world, it moves higher, and then you make your adjustments on the stop based on your predetermined plan. However, we all know that when I buy a stock, it could go immediately down. So what I've done is implementing it too early. Let it breathe, let it flex, let it go up and down before you put that on. Now, how you do that and the numbers, I'm gonna avoid. But keep in mind, that is one of the bigger mistakes. Adjusting the stop based on performance, this would be your obvious first choice, but I thought implementing it too early would be a little bit more common, and it's usually overlooked. But not having any predetermined rules, you're just emotionally reacting. You see a big red candle, you see something happen in the sector. That's the most obvious. It usually results in an emotional reaction to do so. It's usually Hey, I saw something, a big red candle, so I need to break some rules and adjust this way, or vice versa, big green one, and I've got those down here as you go further down. Managing on a different time frame than traded. Okay, I'm going to get in, I'm going to buy. I've got my daily candlesticks, my daily chart. I'm going to be in this for 5 to 10 days, and immediately you zoom in on the hourly chart to find a place to put your stop. That is horrible, and it is a cute thing. I say trying to get cute and adjust on a smaller time frame to avoid corrective moves. You have to let this go against you so it can go for you. The push pull, the bull pullback, the bear rally. You've got to let these things oscillate. Too often my traders get into the daily candle, they zoom into the 1 hour, and they're like, okay, let me find some support resistance here on the hour. And what they don't realize is that they've actually shrunk the whole range of the day. And they've actually increased. I've got some statistics here. We're going to get out and do some live stuff. It's kind of fun. You've increased the probability of being stopped out. Isn't that crazy? Squeezing, adjusting down, fear of missing out is what I like about the squeezing. You see that big green candle, once again, usually on an intraday chart, an hour chart, a 15-minute chart, where, I want to be in this for 6 days, yet it has a intraday $1 move. And you immediately get in there and try to, maybe I should just squeeze the stop or get out now, so on and so forth. So, yes. Now, on the other side, and it's the kind of a fear thing, well, I guess it's a greed thing, is adjusting down. I guess what it is a delusion thing, right? Because, hey, it's going to come back. I know as soon as it hits my stop, it's going to stop me out, and this stock is going to turn around and go the way I want it to. That is the Murphy's Law of it. So what you'll do is I'll just open my stop a little wider. I'm risking $1. I'll risk $1.50. Let's go ahead and do that. So these are very common emotional mistakes. Now, they're all specific to stop orders, but they're all emotional impulses because of the performance of a stock. This is what's so tough about the mistakes that you can make by watching the screen. So keep that in mind. So I've got this little slide I put together. It was kind of funny. We taught a summit years ago, and we actually pulled statistics from some options trade. It was called the Options Oracle. Thinkorswim does this as well, and it spits out probabilities: probability of touch, probability of being in or at the money at a certain time. And I'm going to show you this here in 1 second with Thinkorswim. But so we pulled up a random stock. It's a 47.74, and we said, okay, what would you see in a $1 stop loss, $2 stop loss, or an 8% stop loss? And here you have these little statistics. So in 5 calendar days, we chose a week, right? I'm going to show you here in a minute that we can actually go as far out as you want based on what you want to choose to. So 47.74 is 100% because that's where it's at right now. So we figured a $1 stop loss is at 46.74. There's a 77% chance. Now, this is all statistically based off the volatility of the stock, that it's going to touch $46.74 in 5 days. You've reduced the success of your trade by 77%. So think about that. We always get into the top-down approach, the probability, hey, here we are, we got a chart, that gives us probability, we're looking for that 60%, 55%, whatever. Well, by implementing a stop at $1, we have decreased success by 77% over 5 days. Think about that. Now, this does get better as you go further out. Obviously, $2 stop loss, that's still 55%. Now, what this is the probability of it actually touching that number. I see it as reducing our advantage by that percentage. Open it up to an 8% stop loss, folks. And once again, I'm not here to teach how to use stops, but you'll see that they're great, but they've got to be super, super wide, and you've got to slow play these things. It's not something that, hey, I've got a $10 move in a stock, and I'm going to put a $1 stop loss on it. You get a $10 move in your stock, you better have a 10 to 15% stop loss on that because you need to let it breathe. This also falls into targeting. So 24.3%. Okay, that's doable. That sounds like something you can do. Keep in mind, that's a 24.3% reduction in the overall probability of the trade itself. So every time you see those percentages, it's the reduction of the advantage that you had when you started the trade. Kind of funny to think about. Okay, so let's move over to kind of a live example here and see what we can get out of this. I have Microsoft up, guys, and this is pretty easy to do because with Thinkorswim you can do it on anything. I just happen to have it up, and this looks kind of fun. So let me do my penmanship because we like to draw, or I do at least. I've got a nice ascending triangle pattern here. It looks like a cool breakout. Definitely a bull trade. That's not what we're talking about. Let's say we're already in this. What we're trying to look at is the statistical probabilities of what Microsoft can do up or down over a certain matter of days. And what's really neat about this, it's all done here on a click of a button. So if you're ever thinking about, well, let's start it here. If you're ever thinking about, I'm going to put a stop on the previous day's low, the previous swing low, right? Pivot point. This is one of mine. This is why I have this up. I know this is a black pin, so I will stay off the black. ATR, $4.61. I'll use that to place a protective stop, so on and so forth. With that in mind, you can now go out and pick some numbers. So I'm going to go back and forth here, and where you're going to go here is to analyze and under the probability analysis. So usually when you go to analyze, guys, it's got, add your trades. It'll show you your options, risk profile. If you want to choose the option, once again, the probability range will be on this, but we're going to stick specifically to stock or just the move of the underlying. So this probability analysis. Now you have of in the money, out of the money, or touching. I'm at touching here because I just want to say, hey, if this goes down to, $325 and it touches that point and it activates a market order to sell my option, that's just as bad as if it's going to be in or out of the money for me. So I say, hey, what would activate a stop order? Now, it's got a curve. What's really cool, it posts the volatility there. So any stock we put in, and immediately we get results. It has expiration cycles across the bottom here, folks. I know I'm turning this into a Thinkorswim lab, but it's pretty cool to see. And then what it does is it gives you the ability to put in price slices. The middle one defaults to the current stock price, and that will change. You want to keep that unlocked. And then it gives a plus minus 10% deviation. You can offset it by standard deviations. You can change it anything you want. So what I'm going to do is type in specific numbers over a certain amount of time. So let's go back to the chart and let's find some of these levels. Now I do have my calculator handy because I am not good at math without it. So let's talk about our first area here. So let's do I can't do the low of the previous day because today's a little bit lower. Let's do the pivot low. So I'm going to come down here and just get the low of one of these candlesticks. 330.51 is this one. This one is 330. Yeah, we'll call it 330. 330. So I'm going to go back to my analyze, and I put my 330 right here in one of the price slices. That way I don't have to move my cursor around. 330.00. Hit enter, and it locks it in. Now what's really cool about this is if you guys look up here, it'll give me all of the statistics of it being able to hit that point based on these expiration cycles. Guys, I'm going to go ahead and let's see if my spotlight works. There it is. Cool. Follow my spotlight if you can see it, right? So within the next 4 days, which is November's expiration, there's a 15.65% chance that it could touch 330. Now this progresses on down the road. 11 days after that, the November expiration, 39%, 51% if we go to December, week 1, so on and so forth. So you'll see this is giving you the probability in a percentage of it touching 330 over these time frames. Now you can do this manually by just dragging your cursor around, but I like to actually type in hard numbers. So I've got that 330 up there. Let's go back and take a look at one other one here. Let's see. Let's do an ATR. Let's do one full ATR. So the ATR is $4.61. The current stock price is, let's call it 341.56. Sorry, folks. I got to get into my phone first so I can use the calculator. Okay. 341.56 here. And then let's minus that ATR of $4.61, 4.61, and that's going to equal 336.95. So a little tighter than just using the pivot point here. But for fun, let's go put that thing in here. Let's go put it in. We'll leave the 330. I can change this number to it. So 33695. Hit enter. Let's get my little highlighter out here if you guys can see my spotlight. Hopefully you can. And you can see here's the 336. It moved the 341 to the top because they're lower numbers. Wow, 57.44% of hitting this thing at $6.95 earlier than our previous support level. So, these numbers are going to come out like, okay, Joe, that's obvious. The idea is to find something that you can get behind. Let's go back to the chart here, to where it becomes obvious enough that you can implement it, but at the same time safe enough to where it's just not going to be, you're not going to get whipsawed. So you look at it and say, if I put it below the previous day's low, yeah, you're going to be really tight with that thing, right? You're not going to lose much. You're not risking much at all, but you have a very low probability of surviving the next 2 or 3 days, especially if your target's 5 or 6 or 8 days out. So that's a fun place to play. If you guys really want to do it, I really suggest jumping out there and actually playing around. So let's get back to it here. The idea is, where does this hurt? And it's pretty obvious because it's specific to one side. You've got your win-loss versus your gain, dollar loss. It's going to absolutely change your success, your winners versus losers. The psychology behind the stop loss, and what I found in my trading when I first did this, is I had in let's say 10 trades, I was stopped out of 8 out of 10 trades. So I had 8 losers, 10 winners. Or excuse me, 8 losers, 2 winners, but I only lost like a couple $100. So I had 8 very, very small losses and 2 okay gains. And so this kind of has this weird snowball effect to it, folks, because when you start squeezing and playing stops and not allowing a trade to work, your second reaction is, okay, I've had 10 trades, 8 of which I've been stopped out of, mostly because of my fault. I was too tight. I was adjusting, willy-nilly. I was doing different time frames. But you get to a point to where I don't want to lose anymore. I want to get to 8 winners, 2 losers. So you start taking profits earlier. And it's this cycle of, not only are you squeezing yourself out of good trades, but you also start to cut gains. And I've got another video for that coming up. So it's kind of interesting, isn't it? But keep in mind of the true risk in using a stop, and more importantly, how you implement it. Make sure that you have a solid, measurable rule when you use it. Now, they're wonderful. I'll throw a few out there. After I get my initial gain, when I reach my target, when I have exceeded 50% of my risk, that's where I'll start, adjusting a stop loss. This is where you can actually start to squeeze past your targets. We always say, hey, let your runners run. Well, that's how you do it. Let them get there, and then, okay, let's see if I can go higher from here. But in order to do that, you need to risk more than you want. So, like I say, that snowball effect of, like, you squeeze it too tight, then all of a sudden, next time you see that you get a gain, you take it real quick because you haven't seen a gain in a long time. You've been stopped out too often. So, vicious cycle. Emotions will drive the impulse to adjust the stop. When you see that big green candle or red candle or whatever you want to see or don't want to see, your emotion is going to be, let's lock it in. Let's lock it in. It's like you're not locking it in at that point. What you're doing is you're suffocating it, not allowing it to breathe and grow. Your personality will dictate how or if you should use stops. Now, I'll end it there because what's really cool, and I'm glad it's number 4 because I need to end it. There's traders that can do this. There's traders that can't. Over the years, I started as a day trader, and I thought I was really savvy. I really did. Pretty good at it. I was really good at it because I was in a bubble, and I just bought everything and held it and whatever. But what I didn't like is that every time I seemed to make a change or a decision on where to put that stop loss, it never worked. I've personally got rid of them. I position size things to let themselves play out, giving me the full probability percentage and benefit of allowing my top-down approach to work for me. Now, it does bite. it does bite you. You know, like, oh, if I would have adjusted the stop there, I would have saved, X amount of dollars or locked in this much or even taken less of a loss. However, the other side of that coin is once it goes down and hits your stop loss and then turns right around and ends up exceeding your target, that also burns. So you're listen to your heart, listen to how you feel, listen to what makes you jump and push a button versus not. That is the correct way you should be implementing stops, if at all. Because the last thing you want to do is fight yourself. And once again, it's hard for me to realize that I am not a very good day trader. And yes, that pains me to say it even today. I'm not. It sucks. But if I try, I'll screw it up and I won't do very well. If I understand that who I am is a guy that can't day trade and I don't day trade, I do better. So I guess that's my little soapbox. But keep in mind, guys, that's what these are for, these little psychology classes. Find out what you are, who, and what you can and cannot do, and accept it, and then make this work for you. All right, guys, thank you so much. I appreciate it. I'll see you next time. Bye, everyone.